to the What Bitcoin Did podcast.
Hi there, how are you all? Welcome to the What Bitcoin Did podcast. This week I have a follow-up interview with Kyle Samani from Multicoin Capital. He was one of the first guests I had on the podcast, and I will share a link out to that in the show notes. But before I talk about the interview, I do have a message from my show sponsors, and please do go and check them out. Please do listen to these ads, and please do go and check their links out, because these are the people who enable me to keep the show going. So firstly, I'd like to tell you about BlockFi, who offer crypto-backed loans. If you are holding on to crypto, you can put your Bitcoin and Ether to work without selling. BlockFi gives cryptocurrency owners access to cash through lowest cost cryptocurrency to dollar borrowing. BlockFi have also created a special offer for you listeners. So if you sign up at blockfi.com/whatbitcoindid, you'll get $25 in crypto added to your collateral balance for loans under $10,000 or $50 in crypto for loans over $10,000. And the applying for this takes only about 2 minutes. So that's blockfi.com/whatbitcoindid. BlockFi is spelled BLOCKFI. And secondly, I would like to talk to you about Casa again. You know Casa from when Jameson Lopp came on my podcast, where Bitcoin has enabled individuals to be their own bank for nearly a decade. There are many people who are either choosing to trust third parties out of convenience or are finding out the hard way that they did not sufficiently prepare to be a bank. Casa enables you to secure your own private keys without having to convert your home into a physical fortress. The multi-signature, multi-device, multi-location architecture keeps you safe against theft, disaster, and even negligence. That means Casa also helps with inheritance procedure, passing your crypto wealth to your heirs with keys in their control. Let Casa guide you through the high learning curve of key management in order to avoid unforeseen pitfalls. You can find out more and apply for Casa today at keys.casa. That is KEYS.casa. And also, if you didn't see this week, Casa launched their Lightning nodes, of which the first 2 batches sold out almost instantly. I've ordered mine, and I suggest you check them out at store.casa. I think they're taking orders now for their 3rd batch, and that will be available in December. I've wanted to have a node, and this is probably one of the easiest ways to get started with both a Lightning and Bitcoin full node. Okay, so on to the interview with Kyle. As I said, this is the second time I've spoken to him, and I will share the original interview out in the show notes. And if you don't know him, and you don't follow him on Twitter, I suggest you do. And I suggest you read some of the blog posts on the Multicoin Capital website, which I will also share out in the show notes. He definitely splits opinion. Maximalists think he talks nonsense, but there are a bunch of people I know and I have met and just talked to who really appreciate and understand the work he does. And I think over time I've figured out what his approach is, and I talked to him about this in the interview. But ultimately, Kyle is a hedge fund manager. He's looking to generate a return on capital, and he positions himself at the center of all these altcoin and token projects, and he's relentlessly looking for truth and value. He is looking where the technology can be applied. If you notice and you watch the way he works, he will debate, he will question, he will challenge, and he sparks debates, which he uses then to theorize and drive investment decisions, which is quite an interesting approach. He obviously needs thick skin, because in doing this, a lot of people will challenge him. I think I've seen a few memes about him, but I think I understand what he's doing. He is also one of the toughest people I've interviewed. You will often hear people say, the more you learn, the more you don't know. And despite preparing diligently for this interview, we head into some topics which I could not debate the way I wanted, because I didn't have the knowledge to challenge him. And despite me having a gut feel that I didn't agree with him, especially with proof of work v proof of stake, I ended up leaving with a bunch of notes for things that I had to read up on and learn more about. Kyle is also a relentless worker. I'm pretty sure he doesn't sleep. Whenever I email him, it doesn't matter what time zone I'm in or what time it is, he usually replies pretty quickly. So I'm convinced he doesn't sleep. And after the interview, we discussed his approach to kind of research and knowledge. And it's a shame we didn't record it, actually, because I think it would have been useful. And I will probably have Kyle on again in the future. And it's something I would like to talk about with him. So look, as much as I buy the maximalism argument, I'm completely open-minded to other applications of the technology. And if there are other projects out there which will build sustainable models, I'm pretty sure Kyle will find it. And he'll probably do it with little care for how many times he might be wrong or what people say about him. And, that's not a bad thing. So please support the show. I ask this every week. It's really helpful. I do very well in iTunes, thankfully, and that's down to people who listen to the show leaving me a review. So if you haven't left me a review, if you enjoy the show, please do head over to iTunes. It only takes you a few minutes, and if you think it deserves 5 stars, that's really cool. And to everyone who's emailed me to tell me they've done it, thank you so much. Please also follow me on social media. I'm on Instagram, I'm on Twitter, I'm on Medium. My handle is @whatbitcoindid, and if you reach out to me, I will usually reply. Please check out my website. I'm definitely working on that. I've got a new homepage now. That's at www.whatbitcoindid.com. And you can also sign up to my newsletter. And please do share this out with your friends and family. Okay, so on to the interview. I hope you enjoy it. If you do have any questions about it, if you want to reach out to me, feel free to do so on hello@whatbitcoindid.com. And I think I reply to almost everyone who gets back to me. Hi there, Kyle. Good to see you again.
Peter, good to be back on the show. It's been, 4 or 5 months?
Yeah, about that, and a lot's happened for Multicoin since then. You've raised, 75 million?
The last time we publicly disclosed our UM, it was about 75.
Excellent. And obviously a lot's happened in the market, and it's given me a lot of questions for today. A couple of things, though. First thing I wanted to start on is just a minor observation about how I think you work, and just tell me if I've got this right. I think you've got very thick skin, and I think you put out as much information in terms of thoughts, but also questions with the ultimate goal of finding out where there is value. Am I right?
Yeah, you nailed it on the head. I mean, either I ask questions or I post, controversial opinions. There's a famous or a funny kind of a law. It's called Cunningham's law, and it basically states that on the internet, the best way to get a question answered is not to post a question, but is to post the wrong answer. And so, I frequently tend to post the wrong answer, and I can get informed of this quite quickly. So I believe very strongly in the power of the kind of feedback cycles and leveraging the power of the crowd. I think more than kind of any of my direct peers, I kind of use that both, again, with being a little bit divisive and with asking just very open questions. And we actually very much incorporate that into our thinking at Multicoin. It's very frequent that an investment committee will pull up a Twitter thread that gets a bunch of responses and a bunch of debates, and we'll actually talk through the merits of kind of both sides of the argument. And I think the fact that I can do that basically at a whim is actually an asymmetric advantage.
Right. Okay. And another thing I've noticed is there's a slight change in your view on Bitcoin. So
tiny bit.
So let's go back. Let's go back to your post, 25th of July, TLDR. I'm bought in, kind of. All right. So you give me the background, and then I'll start throwing at you some of my thoughts.
Yeah, so I made it a priority this summer to really spend more time really trying to empathize with the Bitcoin maximalism view and the maximalists, and understanding the literature they've read, and really tried to kind of engross myself in that culture and that ideology. And after spending a few months doing it, I've basically come around to the view that I think I assigned the probability that they are right is higher than I had previously assigned the probability. Whereas before I'd consider the probability, let's say, near zero. Today I assign the probability at, let's say, 10 or 15%. And so, because of that, my views on Bitcoin have changed. I still am generally of the belief that the store value hypothesis and that the prioritization of only focusing on just being quote unquote hard money at the expense of all of the forms of utility or usability or usage, I still think is incorrect. Or I think it's correct. I think is unlikely to produce the global digital reserve asset in the long run. But I have come around more to the view that path could in fact be the path that it takes.
And can I guess the 3 books you read were The Demonetization of Money, Debt the First 5,000 Years, and The Bitcoin Standard?
Yep.
So, okay. So if your view's slightly changing, does this mean your investment thesis is changing, and are you now hedging with Bitcoin?
So we've been long Bitcoin for quite some time. We're long Bitcoin today, and we expect we will be long Bitcoin for the foreseeable future. Relative weightings obviously matter here. And today, Bitcoin is a material position, and has been. It's not like a 50% position or anything I'd say of that magnitude, but it is a material position in our fund today. we have not, like, over the last quarter or so, we have not increased our Bitcoin position as a result of like internal discussions about this particular issue. I tended to lean more extreme against Bitcoin inside the firm than many others, and I've kind of come around more, centrist, if you will. But that has actually not impacted portfolio construction in a meaningful capacity in the last 90 days.
Okay, and then within that thread, you also said Bitcoin maximalism is objectively stupid. Were you being provocative on purpose?
Always, of course. I mean, the fact that over such a long period of time I fanned the flames with them is what ultimately caused me to go deep into Bitcoin land, and actually ultimately come away, I think, with a more nuanced and complete understanding of the Bitcoin maximalism view. And also, I believe I have a more nuanced understanding of why I think it is unlikely to produce the global digital reserve asset. But I do I believe I understand more completely, why they think the way they think.
Yeah, so I found it kind of interesting. I've been on a similar path, probably not as deeply researching as you, but struggling still sometimes to maybe find value in a number of the projects that are out there. It kind of feels like the FAT protocol thesis has mainly been debunked recently. I know you're not completely against it, but there's been some criticism of it, and there's been a struggle to find value in a number of the projects. Not only because the projects themselves are struggling for users, but also the ability to release capital by investors. So I've kind of gone a similar path to you, but I think we should explore this. So I've taken some of your notes from that tweet storm, and you made kind of 3 or 4 interesting points. The first one was that very likely that after the 2024 halving, that this creates a problem for layer 2. So can you explain what you meant by that?
Yeah, so basically it's actually been proven that it becomes game theoretically not optimal for miners to release today in Bitcoin. It is game theoretically optimal that whenever a miner finds a block, that they should immediately propagate that block to as many people as possible as fast as they can, to maximize the probability that their block is ultimately included in the canonical chain. Given the way Bitcoin finality works probabilistically, like that today is game theoretically correct. The reason that works is because if you look at miner compensation, right, there's 2 forms of miner compensation. One is inflation, and the other is transaction fees. And today, something like 90 to 95% of miner revenue is inflation. And I think even when Bitcoin fees were at their highest, like in the December timeframe, I think, transaction fees were 40% or something of miner revenue. But today it represents 90% plus of revenue, maybe even more. And so when you consider this, right, as inflation decreases, the rate of inflation, decreases in the system, like there's literally just less money left to reward the miners. And, as the ratio of capital of fees paid to miners for inflation versus transaction fees, is that ratio flips, it like becomes game theoretically possible to not propagate blocks immediately. And when you start kind of compounding that across multiple miners and multiple blocks, and then if you're relying on, blocks for things like entering into a Lightning agreement, right? HTLC for Lightning, that starts to create very strange behavior. And just makes the system overall, I don't want to say the word brittle, but it certainly makes it a little more flimsy. And so that can create a number of strange compounding problems.
Okay. And then also you said that there's lots of reasons why layer 2 technology might not be adopted. Yeah,
I mean, layer 2 technologies, I've come to the conclusion that they will be adopted at least to some capacity. It's still very much TBD. The number of people that need to really buy into Lightning and agree to use Lightning is actually relatively small for Lightning to work. But conversely, if they don't buy into Lightning, then I think it's unlikely to work in a meaningful scale. And those hubs very obviously are the exchanges, right? So Coinbase, Binance, Bitfinex, Bittrex, Poloniex, et cetera, right? Like these are the people that need to do this. That fiat on-ramp to crypto, like these people sit on the exchanges, sit on so much, Bitcoin collectively. And if they choose not to do Lightning for any reason with the other exchanges, I think it's unlikely that you're going to see kind of meaningful adoption. I think the idea of liquidity providers emerging who are just liquidity providers that are not attached to existing fiat on ramps. I just find that to be extremely unlikely. I don't see where all that capital will accumulate from. Again, at meaningful scale, right? I'm talking $10 billion worth, $15 billion worth, not $50 million, like real amounts of money. And so if those people don't sign on, I don't see how the Lightning vision really works in a meaningful sense.
Okay, and then you said there's no fundamental logic that the global digital reserve asset must be a store of value first before a medium exchange. And then you said at ETH or EOS current scale, they are enough of a store of value to power meaningful commerce. Does the order really matter?
So I think my issue more is with the Bitcoin maximalism view that it must become a global store of value before anyone would ever use it for any commerce. And I think that is like materially debunked today. We have a lot of empirical evidence that that's false today. If you hold EOS today, you likely believe EOS will, for example, will be worth much more in the future. If you hold Ethereum today, you likely believe Ethereum will be worth much more in the future. Despite that, people continue to transact with it, do commerce, engage in betting markets on Augur, whatever, like all kinds of different things. And like at the level of scale, whether EOS today is worth, let's say, $5 billion, Ethereum today is worth, let's say, $30 billion, like that is not global store of value scale. Like, that's multiple orders of magnitude away, but it still is being used to power meaningful forms of commerce. And so what I take issue with is the idea that it has to be a store of value, until some call it like level of scale, let's say it's 5 trillion or something. And at that point, it can start to be used as a medium of exchange. We have quite a bit of empirical evidence that that's just not correct. And moreover, I think there is real merits to the idea that money has kind of multiple dimensions. There's obviously the hard moneyness of Bitcoin and digital gold, and there's obviously very rational libertarian Austrian appeals to that. But there's actually much more. Money acts in many ways. Like if you ask, actually just yesterday we were talking about this in our investment committee. One of our employees, his father-in-law, he asked him what is money. He said money is whatever you can go to the grocery store and buy groceries with, right? So to him, money is the ability to spend it, right? And the other person to accept it. And so, and then you look at all the kind of financial primitives being built with things like Maker and Augur and Dharma and these other kinds of tools. And it seems pretty clear to me that it's very myopic to interpret money as just fixed supply, scarcity, can't hack it, censorship resistant. All of those are all certainly strong benefits of a money. I think it's rather myopic. Basically, those 4 to 5 traits are the only ones that matter, and everything else is stupid. It seems pretty clear to me that, like, in order for money to be money, it needs to be used as money. And so, I think the idea of get to 5 trillion and then people will spend it, I think that's incorrect.
Right. Okay. And then the last point you made was that you find it quite likely that proof of stake will deliver stronger security guarantees at scale. And why is that?
Yeah. So this one I actually feel this is probably contrarian within crypto and aggregate. But I've spent enough time on proof of stake systems, understanding them, and I've developed some I think pretty coherent mental models to compare the two. And the kind of key thing with proof of work systems, right, is like the system is a function of inflation times, right? If the market cap is, let's say, 100 billion, and let's say inflation is 1%, then you can actually quantify the security of the network as basically $1 billion, which is that rational market actors will spend up to $1 billion acting honestly to secure the network because they will generate, right, some profits accordingly. And so when you look at proof of stake systems, conversely, if the proof of stake system is let's say it's a $100 billion network, let's say there's 1% inflation, well, in that model, buying up enough of the asset in question such that you could manipulate history or basically execute censorship resistance or censorship attacks or 51% attacks or some other weird forms of selfish mining. In order to do that, it is very likely to cost you substantially more than $1 billion because you would have to buy up that much more ether and have that much more capital at risk. Just like logistically given kind of market dynamics, depth of order books, etc. Moreover, there's a very real probability, like if you're going to do that kind of an attack, in proof of work, it's impossible for you to be forked out of the system. In proof of stake systems, you can actually get forked out if the network can detect in aggregate if you're acting dishonestly. even if you are the majority of the network, if the minority of the network can detect that you're acting dishonestly, you can literally get forked out, which would be catastrophic. You would have, zero return at that point. You'd lose all of your capital at stake. And Vitalik has talked publicly about basically enabling this by default in Ethereum. It's a very controversial view. I'm inclined to agree with Vitalik on this issue, is that if you set that threat that, hey, if the network can detect you doing this at scale, and you could get forked out and get forked out to a hard zero, I think that the risk reward ratio of attacking a proof of stake system, like that risk tolerance becomes so high, because you have a chance of just getting hit with a zero instantly. In proof of work, that's impossible. If you have mining equipment, no one can stop you from mining, and you can always mine. And literally no one can take that away from you.
That's not entirely true, though, right? Is it? Because, for example, with Seacoin, they were going to change their algorithm to fork out the Bitmain miners. So it's not strictly true. You can't on an individual level. It's on an equipment level, right?
So for ASIC miners, that's more true than not. But like specifically in the case of like Bitcoin and like maximal security, I find it extremely improbable that Bitcoin is ever going to fork to change the to change the hashing algorithm, because like the security of the Bitcoin network as the largest coin is explicitly a function of the fact that it has so much hash power. Right, like if you were to fork away from that, you would literally be throwing away all existing hash power.
Yeah,
and I find that highly improbable.
But why would you want to? So in proof of work, why would you want to fork out a number of the miners? Like, because we have it's like a 51% consensus rule, right? So why would you want, like, either the network's under attack or it isn't? So what reason would you have to fork out a percentage of miners? What could they do dishonestly?
I mean, they could just censor transactions, right? They could do block reorgs. Like there's all kinds of weird forms of selfish mining they could do that would be suboptimal for the network as a whole, and would even outright censor transactions. I mean, if you have 55% of the network, and if you wanted to really screw with the network, you could literally.
But outside of 50, outside of having 51% of the network, what can anyone actually do?
I mean, like I'm not going to get into all the nuances of like all the other interesting forms of selfish mining, but you can censor people. You can do all kinds of other interesting ways to tweak the system in your favor. But more importantly, if you have that level of capacity in the network, you like no one else can get rid of you. There is no way to detect which percentage of the hash power is coming from the attacker and prevent them from mining. Like that is actually impossible in proof of work systems as they're designed today. In proof of stake systems, if you can detect the person, you can fork them out.
So how would a decision be made to fork someone out of a proof of stake system?
Yeah, so if you can detect, so let's say there's 100 validating nodes in a committee, and let's say 48 of them come to an agreement that the other 52 are some sort of cartel, some sort of organization, and they are systematically censoring transactions for any reason or no reason at all. It doesn't really matter. As long as they can detect some pattern of censorship or some other form of behavior, then those 48 can literally fork out. Like they know who the 52 nodes are that have the coin stake to be those 52, and they can literally slash them to zero and fork off and just go in a new direction. And then those 52 have no weight anymore.
Is that a fork in that there would then be two coins?
Yes, there would be two coins at this point.
So that doesn't sound an optimal solution then, because you run the risk of having a disagreement on the coins and having a similar situation to, say, Ethereum and Ethereum Classic. Yeah,
correct. I mean, this would not be trivial, but right, this is the kind of thing you don't exercise if you have proof that this is happening. And so, like the way this proof would happen, right, is if there are users all over the world who are submitting transactions to the network, and let's say the 48 in the minority systematically see that they are all receiving this set of transactions, and those transactions are not being included in blocks produced by the other 52. And if you can see that pattern systematically over an extended period of time, right, you can actually prove this in an objective way to the rest of the world. And so, yeah, of course, there's going to be like divisiveness and fighting, and like that's never going to stop. You can actually produce a proof of malevolence and cite all the reasons and demonstrate that publicly. And so, although it'll always be contentious, like you can actually still pull it off, in my view, in a much easier way than, let's say, the DAO fork, which is a function of values. The other nice thing here is kind of, again, defaults in social consensus. So if everyone opts in to use, let's say, the Ethereum network, in which default fork in the event of 51% censorship right? Let's say that behavior is opt-in default, right? Well, then everyone has already agreed by definition that like we're all agreeing to do that. So in the event of that fork happening, it's like, okay, well, we already agreed that we would act in exactly this way. And then the thing happened and now we're acting in the way we said we would. So it's actually very logically consistent.
So from my side, look, I'm not the most technical. I've told you that before. But I always try and do little experiments just to test myself. So I mine. I've got 70 S9s and 90 Dragon Mints and one Seer miner. And every month I'm having to balance my power cost and against my mining rewards. And at the moment, the last 2 months, I've been mining at a loss. Now I'm moving to a new factory. So I've got a cost for that, to a new center, which is going to take me back to just below break even. But I also stake with Zcoin, just out of interest. And with Zcoin, I don't have to do anything. I'm staking, and every, I don't know what it is, like 15 days, I get 15 more Zcoin sent to me. But with Bitcoin, with the proof of work, I'm actually having to consider the economics the whole time. And that to me makes it feels like a much more secure way of securing a protocol, because the proof of work is in the name, right? You have a cost risk associated of not following the rules, whereas I don't really have a cost risk with Zcoin. Can you understand why, therefore, I'm struggling to see, and other people are struggling to see why proof of stake is preferred over proof of work? Because once you've bought in...
So the flip side of this is you have to honest behavior and dishonest behavior. So in the event that you're mining honestly, the fact that you're mining honestly is actually purely wasteful, right? And that's reflected in the fact that you're actually losing money as a miner, even though you're mining honestly and not trying to do any shenanigans, and you're following the protocol honestly. The key with proof of work is that it disincentivizes, in order to disincentivize dishonest behavior, it creates this tax, this cost on all honest behavior as well. The key in proof of stake is you're not creating all of this exogenous cost in the event of honest behavior, but in the event of dishonest behavior, it can be detected and can be systematically managed accordingly. Okay. And so that's kind of the fundamental, like, you have to split that and kind of consider the two. There's different forms of dishonest behavior, and you need to account for some edge cases and interesting things, but at a high level, that's the way to think about it.
So if Jimmy Song was on this call, he would disagree with you, right?
That's very probable.
Next up, I talked to Kyle about what he would do to improve Bitcoin, his article on aggregation theory, thin protocols, and decentralization, and we also talk about Augur. Before that, though, I have a message from my show sponsor. If you're holding on to Bitcoin and Ether and would like to put it to work without selling, then you might want to take a look at BlockFi. If you are bullish on crypto and don't have the cash you need to start a business, finance a home, pay down debt, or anything else, BlockFi can help. It's just a home equity line of credit. BlockFi gives cryptocurrency owners access to cash through the lowest cost crypto to dollar borrowing. With the largest crypto-backed lending footprint in the US, BlockFi offers regulatory compliant loans that can be delivered into your bank account in less than 90 minutes. They are the only cryptocurrency to USD lender to receive institutional investment, enabling them to provide the most affordable and trustworthy lending service within the ecosystem. And they have also created a special offer to listeners of my podcast. If you sign up at blockfi.com/whatbitcoindid, which is blockfi.com/whatbitcoindid, you can get $25 in free crypto added to customer collateral loans for under $10,000. Or $50 in free crypto added to customer collateral loans over $10,000. And applying only takes 2 minutes. So let me ask you a different question then. So I've read, and I've read them a few times. They take a while to get my head around, but I've read your articles a few times. And for those things you're invested in, you are constantly looking at different ideas to improve them, or different theories, different thesis, and all very interesting. But thesis for these protocols being successful, right? But with Bitcoin, I find your writings tend to be more about debunking Bitcoin. So let's flip it. If you were to make changes to Bitcoin and you wanted Bitcoin to be the successful global store of value, what would you do to improve it rather than debunk it? Let's.
My Bitcoin maximalism is rooted in the idea that it should not be basically, no one can change it, no one can control it. As a result of that, you cannot basically evolve from the status quo. All changes have to be soft forks or have to be like layer 2 kinds of things. and that the base protocol basically cannot change, other than like some sort of catastrophe. And my sense is that although that feels like the right story to tell, and kind of like, hey, digital gold, like gold doesn't change, like people want hard sound money. Like I understand the appeal of that argument. I think in the long run, if you don't evolve, you die. And so you have this kind of fundamental like value set of like how frequently do you evolve and change? And the answer for Bitcoin is at the core layer, the answer is not at all under any circumstances. And obviously the value set for basically everyone else is at some frequency higher than Bitcoin. And, you know, I kind of disagree with that value set on a long enough time scale. So, like, I don't know what I would do to try and make Bitcoin more successful, because my ideas would just kind of be fundamentally like contrary to what makes Bitcoin Bitcoin. Within that framework, you know, like working on Lightning, like working on interesting new forms of privacy, like Schnorr signatures as a soft fork. I mean, given the framework and the bounds on which, you know, the Bitcoin community tends to operate, I think they're generally being quite rational and generally operating reasonably. I just disagree with the bounds that have been placed to begin with.
But I guess up until now, there's a strong argument to say that Bitcoin maximalists are being proven regularly right. So Bitcoin Cash, as a way to scale Bitcoin, has pretty much proved itself as a failure. People don't want it. People haven't adopted it. Ethereum has also had its scaling issues. EOS has had its issues. Like plenty of other protocols and ideas have had issues. Yet Bitcoin has, of everything, managed to probably retain value the most, outside of like obvious rare cases like, I don't know, Binance Coin. It's retained most value over this period of time. So maybe the theory of sound money is right.
I mean, Bitcoin has retained value relative to most alts over the last downturn. I don't think that's in any way reflective of like its efforts to do scalability correctly or not correctly, or anything else. It's the brand, it's flight to safety, like it's a bear market, risk off. I don't think you can read much into that. The fact that it's the largest generally is obviously a very function of being first, and being conservative, which is reasonable. I do think the Bitcoin story is by far the most coherent in the market today. I mean, I think it's far and away has the most coherent story to tell today. If I'd spend time today talking to a lot of institutional investors, and you know, half the conversations are like crypto stupid, but another half are, okay, look, we get Bitcoin, like this makes sense. What's all the rest of this nonsense? And that's a pretty consistent level of understanding. And the reality is the Bitcoin story is easier to understand. The thesis is fundamentally coherent. It makes sense. There are a lot of people who are politically predisposed to buy into that, who may not be Bitcoin bugs or Bitcoin maximalists today, but just given their current political leanings, once they learn about Bitcoin, they realize like, oh yes, I agree with this ideologically. So I do find the Bitcoin story is by far the most coherent, but I think that really in no way reflects long-term opportunity to become a global digital reserve asset. So if you had to bet on it, we heard on Laura's show, I don't know if you heard her, and had Jimmy and Joe Lubin discussing a bet. Would you, I mean, I'm not asking you for a bet right now, Carl, but would you bet against Bitcoin then? 10 years from now? On what time scale?
10 years?
On a 10-year time scale, again, Bitcoin is not going to zero. I don't even think Bitcoin is going to be irrelevant in 10 years. I do think in 10 years time frame, there will be at least one asset worth materially more money than Bitcoin.
Okay, interesting. And you're still hedging across multiple different protocols, right?
We own, we're long and short quite a few positions.
Okay, so say during your research, reading the various books and going down the Bitcoin maximalist rabbit hole, if you'd have come out of that a Bitcoin maximalist, would that have presented quite a difficult decision for you within the fund?
No.
Not at all? What would happen with the rest of your investments, say?
I mean, like I run a hedge fund, and like hedge fund, like I have no mandate to buy things and come back in 10 years. Like I manage capital every day. I can move it around every day. Mm-hmm. So my mandate is to simply return capital I mean, obviously long-term I want to return more capital, but the market moves short-term. There's different things that happen, whatever. So like, I don't think that's a fundamental problem. there are quite a few Bitcoin maximalists who do run hedge funds. Brent, the Tetris guys, for example, are very publicly Bitcoin maximalists. Arjun Balaji is launching a new one right now. He's publicly a Bitcoin maximalist. There are a number of other folks in the space who either are publicly or privately are Bitcoin maximalists, and they run high profile funds in the space.
But it's, I guess, purely on a return level. I guess it's harder to create a return from Bitcoin than it is from these alternative projects, because these all, if we look at, say, the Definity returns for early investors, there's still a lot of opportunity for funds to make a lot more money on new projects than with, say, Bitcoin, right? So,
I mean, like, generally, yes. That's why not everyone is just 100% Bitcoin. Like, that by definition is true.
Right. Okay. So I also want to talk about your most recent post, the aggregation theory, thin protocols, re-centralization, the Augur edition. I've read it 3 times now. I still don't understand it all, which is because it goes into a lot of detail. But let's talk about it. Okay. And we're going to return back to the previous point. I believe with extremely high conviction that a global digital reserve asset will be worth tens of trillions of dollars. You've written before about the path to trillions of dollars. So tell me what this global digital reserve asset looks like in your mind.
I think it is very probable that the global digital reserve asset is the protocol that secures. Today we have, like, I think somewhere on the order of $250 trillion of assets around the world, real estate, equities, debt, etc., plus kind of cash, money, and mutual funds and other kind of money substitutes. Somewhere on the order of 250 trillion, if I recall correctly. The vast majority of those assets today are equity, bonds, and real estate. By far, those are the 3 largest asset classes on the planet. Today, all of those are managed using basically paper stock certificates or paper, right? Land titles and deeds, almost exclusively. I believe along a time scale, 100% of that will be managed on a blockchain. The idea of having a private key to do value transfer, like to sign a message and then broadcast that message publicly, like that is how value transfer will be done in the future. Like, without question, that will happen. That is the right way to solve the problem. And if you assume that $250 trillion of assets will live on some number of chains, I think it's likely ultimately to converge towards one chain, and that whatever chain that is, I expect that ultimately is going to support the chain itself that supports all of the other assets will also be the chain that's worth tens of trillions.
And is that an aggregated value? So, for example, with Ethereum, would it be the aggregate value of ETH and every single sub-token that represents an asset? Or are you talking about the asset of the protocol itself?
I'm just referring, I think the base chain can be worth, let's say, 50 trillion, and it can secure assets worth, let's say, 250 trillion.
Okay, interesting. And okay. So right now, outside of Bitcoin, who are the contenders for you in that?
Yeah, so I mean, like there's a few, there's kind of like 4-ish major categories on things that could become the global digital reserve assets. I think 2 kind of sort of fall under the store value hypothesis, and then 2 fall under the utility hypothesis. So the store value hypothesis, you've got Bitcoin, and then like within the store value hypothesis, you've got kind of 2 subcomponents. So I think those 2 subcomponents are, let's call it decentralization, maximalism, and let's say privacy. So Bitcoin obviously falls under decentralization, maximalism, and there's I think 2 contenders kind of starting to come out there. One is Chia, which is basically Bitcoin but with proof of space-time instead of proof of work, and the other is, I think, a new protocol called CODA, CODA. Within the privacy bucket, right? You've got Zcash, Monero, Grin. Who else? Maybe Multicoin kind of fits in there. Those seem to be kind of the real players. And then, within the utility hypothesis, you've got, I think, what's called the medium of exchange tokens and smart contract platforms. So medium of exchange tokens would kind of include things like Bitcoin Cash, things like Dash, maybe Multicoin fits here. And then smart contract platforms, right, is Ethereum, EOS, Definity, Algorand, Solana, Tezos, etc. And so those are, I think, categorically, whatever wins will be one of those kind of 4 sub buckets.
Can multiple win?
On a long enough time scale, I expect you trend towards one, but long enough time scale could be with 30 years. I mean, like 5 years from now, I expect there will be a handful, like call it 5 to 10 that will be, much larger than the rest. But I don't think in 5 years we're going to have like one chain that's bigger than that. Like it's like the dominant chain.
And could there be a scenario with that whereby, look, the assets are issued within this protocol, but as Bitcoin is seen as hard money, we've discussed that, and as Bitcoin is trusted around the world, that still becomes the base currency that people buy these assets with?
I mean, that's the kind of the status quo today. That's actually much less true today than it was 6 months ago. Today, USDT pairs account for quite a bit of trading pairs. So that is, I think, generally correct today, but is trending away from being correct. I expect 24 months from now, a majority of altcoin volumes will not be denominated in Bitcoin.
Oh, but you say because it's trending towards a stable coin.
Just because we're getting more exchanges or adding more non-Bitcoin pairs.
Right. Okay. So also within that article, it was brought up because of Augur, something I've taken a look at. You identified a number of problems with it. I think you listed them: clunky and expensive. It's not a seamless web application. It runs slowly, etc. Why do you think it was such a failed launch?
I mean, I don't think it's a failed launch. I mean, like, so if you're going to say it's failed, meaning that like user growth is not accelerating every day, then the reasons are basically the ones I put in the article. I mean, it's slow, it's clunky, like it's hard to use. I mean, like pretty obvious things. And the reason it's all of those is basically because the Augur app is designed to be as maximally decentralized as possible. And so there's a lot of compromises that were made to achieve that trait. And as a result, you've got a pretty poor user experience. So
do you not actually think there will be an Augur app itself in the future? It will its own one. There won't be a native.
No, there will always be a native Augur app. There's no reason there won't be. I just expect that centralized private companies built on top of the Augur protocol will deliver user experiences that are an order of magnitude better.
So what do you think is needed then in terms of user experience? Because like from my side, I had a play. Yes, it was a pain. I think one of the main issues is most people who want to, like for a broad market, people are going to want to be using a currency they understand, not a digital volatile asset. What about you? Yeah. I mean, obviously, like Augur needs a stable coin, right? Like whether it's DAI, whether it's true USD, whether it's something else, doesn't really matter. But obviously, you need a stable asset to dominate bets in. And I expect like that the Augur team, I'm sure, is working on this. So like this will come in time. And then, we'll see centralized companies on top of Augur deliver kind of everything else. So push notifications, the ability to monitor for accounts, or monitor for kind of new types of markets, categorization, marketing, mobile support, fast loading, just like everything that like this needs to be good can be delivered as a centralized service on top of Augur. So do you think it needs to, as an app, it needs to actually just look like a traditional website or app experience? Yes. No one would know the difference.
Correct.
So why does decentralization matter then?
I mean, you shouldn't have to like, modern user experiences are all rooted in first principles of like, given the context in which a consumer is thinking about solving some problem, the app is designed, all modern successful apps are designed on a first principles basis to optimize for that problem. Doing a betting market today is like the fact that it's decentralized has all these implications for performance and structure and loading, etc. But like what the user sees and the buttons to click on, like that's not really. Augur is fine at, let's say, the user interface level. It's reasonable. It's not perfect, but it's like good enough. The problem is not just the shape of the buttons on the page. The problem is the entire experience end to end of downloading it, using it, etc. And so that's kind of the problem with Augur, which is well beyond just UI. And like as all of these other problems get solved, then it will just look like a regular consumer application.
But why does it need to be decentralized? What are the benefits then? If it ends up looking the same?
Of Augur, censorship resistance and the ability to discover new markets. In the case specifically of prediction markets, it seems quite clear to me that because these markets are today so heavily regulated by governments, that they've actually stifled the opportunities for prediction markets generally. And I think the ability for anyone to create any market and for people to be able to bet on that, I am quite certain will unlock all forms of new liquidity and new types of ways to hedge risk, et cetera, on a long enough time scale.
Yeah, so you're quite bullish on this being a potentially multi-billion-dollar industry?
Prediction markets, absolutely. I think trillions of dollars. I mean, already trillions of dollars of value flow through prediction markets in the form of derivatives today. I expect that auger-based markets will achieve volumes for certainly in the billions. Can they get to the trillions is still very much TBD, but billions at a minimum.
Okay, because the reason I ask is, and we, I mentioned this in your tweet and you replied to me, but I actually found the concept of re-centralization quite interesting. I know that wasn't what the article was about, but you've obviously considered that people will take centralized concepts and re-centralize them for a number of reasons. One, to take a larger share of value, but possibly also for technical reasons.
I think we're going to see people flirting with it. I mean, we've already seen this idea has played out in technology time and time again with the idea of like bundling software and unbundling software, with the idea of, right, like the internet was an open protocol. Then you got this Netscape thing, and then AOL came along, and AOL kind of re-centralized the web. All the search portals before Google all tried to centralize user attention, where this Google said, no, just like search, we're going to kick you out and go somewhere else. So we've always had these kind of competing forces between centralization and decentralization over time, and depending on kind of the state of the market and such, like different things have won at different points in time. Today within crypto, we're seeing the same thing happen again with EOS kind of as an interesting experiment along that spectrum versus something like Ethereum or Bitcoin is one simple example. The idea of proof of stake systems, though, even more generally, if you zoom out a level, the kind of base idea of tendermint, which is powering Cosmos, is called the PBFT, or practical business mean fault tolerance. PBFT was invented in 1999. And despite that, it wasn't very hard kind of technically to make the jump from PBFT to basically what tendermint is. Tendermint is really the first kind of, I'd say the reference implementation of PBFT in a proof of stake setting. And, but despite the fact that, PBFT was invented in 1999, there was literally no proof of stake systems at all until called 2013-ish timeframe. And it took Bitcoin, emerging for that whole segment of research to get restarted. And now we're seeing this massive wave of research around proof of stake systems. So my point to you is that, your question originally was, are things going to re-centralize? And my answer is, we're going to see lots of experiments play out where different people view different layers of centralization, different amounts of centralization at different layers of the stack. Like, those are all open experiments right now.
Okay.
And so we will see that play out.
Okay, conscious of time, got a couple of final questions for you. Where have you had your mind changed in the last, say, 4 or 5 months since we spoke? And, what things do you think you've got wrong, and where's your position changing?
So I think we had a little bit too much hubris going into the EOS launch. We still maintained the same level of general medium-term conviction around EOS that we held before the chain launched. I think we did not spend enough time. We've actually spent quite a bit of time internally reviewing EOS. What could we have forecasted? What couldn't we have forecasted? How could we have sized or not sized things differently, given the information we had at the time? And always trying to adjust for hindsight bias is kind of a challenge, but we've tried. And we've come to the conclusion that we didn't spend enough time reviewing the history specifically of the Ethereum launch and really looking at kind of the mechanics of what happened in the 6 to 12 months after Ethereum launched on a week-by-week basis, understand the challenges it faced, and then try and map those over as best as possible to EOS. And so, since then, we've spent quite a bit of energy internally reviewing what does it really take to launch a chain, and what are all the things you can kind of expect to go wrong in the early days of a chain. And so I think we can be a little bit more we can be more rigorous around risk management going into a launch of a new chain in the future. So we've put quite a bit of energy there in the last few months. I'd say I have become more bullish on the size of the total market for crypto. I think now 100 trillion is doable. Whereas before I thought that was a stretch. I now think 100 trillion is doable. I've become more bullish on zero knowledge proofs to the point where I think zero knowledge proofs will be one of the defining technologies of my lifetime. So become quite a bit more bullish there. We're making 2 investments there right now. I don't know when we'll publicly disclose them, but 2 pretty material investments in that space. I've become a little bit more bullish layer 2 working. I don't think layer 2 is the saving grace that everyone wants it to be, but I see it definitely functioning at a best in limited capacities. But I used to be a little bit more bearish there too, so I'm a little bit more bullish now.
Okay, so and I know you're going to ETH Berlin, but what else is coming up for you, Carl?
I got ETH Berlin. I've got a number of kind of fundraising events in late September. I'm going to be speaking at ETH SF in early October. I'll be at DevCon in November. I'll be at Consensus Invest in November. Those are the ones that I can remember off the top of my head.
Cool. And just let everyone know how they can get hold of you.
Yeah, if you'd like to get a hold of me, I'm pretty accessible on Twitter. My Twitter name is @Kyle Samani.
Brilliant. All right, cool. Thanks for coming on again, Carl.
Hey, Peter. It was a pleasure to be on. Thanks for having me again.
Okay, so what did you make of that? Did you enjoy it? I always enjoy sitting down with Carl. I know he splits opinion, but I find when I'm talking to Carl, I kind of have to up my game. I struggled this week, it was a tough interview, but I did leave with a bunch of notes for things I needed to research. I've been looking at proof of stake versus proof of work, and yes, I've learned some more. I'm still in the proof of stake camp. I don't agree with Carl, but it's only by talking to him and challenging him and listening to him that I've realised I need to go back and increase my knowledge here. So yes, a big thanks to Carl. It's great to have him on. And listen, I know the maximalists might not take him seriously, but plenty of people do. Plenty of people with deep pockets, and I expect Multicoin will continue to raise capital for their fund. And if there's value out there, I'm pretty sure Carl will find it. Okay, please do support the show. I said it at the start. If you can leave me a review on iTunes, if you haven't done it, I would really, really love that. A 5-star review if you think it deserves it. Please do follow me on social media. I am on Instagram, I am on Medium, I am on Twitter, I'm at WhatBitcoinDid on all of those. Please feel free to drop me an email if you've got any questions. My email address is hello@whatbitcoindid.com. And please do share this out with your friends and family. It really does help support the show. Lastly, I just want to say a big thanks to my engineer, Jason Camiola. I will share links to him out in the show notes, but if you have any audio engineering needs, please do get in touch with him. He's an absolute hero. It saves my bacon most weeks. Okay, listen, I've got a great interview lineup for next week. Someone I've been tracking for ages, someone you all know, and I hope you enjoy it as much as I'm looking forward to recording it. Okay, I hope you all have a great week, and I'll see you soon.